When it comes to purchasing a home or property, one of the most crucial factors to consider is the interest rate on your mortgage loan. The interest rate not only affects your monthly mortgage payment, but also the overall cost of the loan. Understanding how mortgage lenders determine your interest rate is essential in making informed decisions and potentially saving thousands of dollars over the life of your mortgage. Mortgage lenders take into account several factors when determining your interest rate. The first and most important factor is your credit score. A higher credit score, above 740, indicates a lower risk for lenders, resulting in a lower interest rate. Conversely, a poor credit score, below 549, suggests a higher risk borrower, leading to a higher interest rate. If your credit score falls somewhere in between, your interest rate will be somewhere in the middle as well. Improving your credit score can be achieved with a few simple steps. The first step is to check your credit report for any errors or inaccuracies. By identifying and disputing these errors with the credit bureau, you can have them corrected, potentially boosting your score. Additionally, paying all your bills on time and reducing your credit utilization ratio can also help improve your credit score. Another factor that impacts your interest rate is the loan-to-value ratio, or LTV. It measures the risk associated with the loan. The higher the LTV, the riskier the loan. Therefore, the higher the interest rate. For example, if two borrowers want to purchase a $300,000 house, with one providing a $30,000 down payment, an LTV of 90%, and the other offering a $120,000 down payment, an LTV of 60%, the borrower with the lower LTV will likely be offered a lower interest rate due to the lower risk involved. Loan terms also play a role in determining your interest rate. Generally, shorter loan terms, such as a 15-year mortgage, tend to have lower interest rates compared to longer loan terms like a 30-year mortgage. Lenders perceive shorter loan terms as less risky since they involve lending money for a shorter period. The type of interest rate can also impact your interest rate. Fixed-rate mortgages usually have higher interest rates initially, but they remain unchanged throughout the loan term. On the other hand, adjustable-rate mortgages, or ARMs, may offer lower interest rates initially, but these rates can fluctuate over time, potentially leading to higher payments in the future. It is essential to carefully consider your financial situation and goals when choosing between these two options. Market conditions also influence your interest rate. Factors like inflation, employment rates, and housing market trends all contribute to changes in mortgage rates. Mortgage rates tend to increase when inflation rises as a measure to control inflation. Conversely, during economic recessions, mortgage rates tend to fall to stimulate economic activity in the housing market. Additionally, demand for homes and properties can impact interest rates, as high demand may result in lower rates, while low demand can lead to higher rates. Lastly, you can often lower your interest rate by utilizing mortgage points, also known as discount points. These are upfront fees paid to the lender at closing in exchange for a reduced interest rate. Each point typically costs 1% of the total borrowed amount and can lower the interest rate by a specific percentage. By paying points, you can save money on your monthly mortgage payments and over the life of the loan. However, it is important to evaluate if the upfront cost is worth the long-term savings for your specific financial situation. In conclusion, several factors determine your interest rate when obtaining a mortgage loan. These factors include your credit score, loan-to-value ratio, loan terms, interest rate type, market conditions, and the use of mortgage points. By understanding how these factors impact your interest rate, you can make informed decisions that align with your financial goals and potentially save significant amounts of money over the course of your mortgage.